Welcome back to the deep dive. We're here to take, really complex source material stuff often buried in corporate speak or legal docs and just break it down into simple, useful knowledge for you. Today, we are digging into one of the most talked about and honestly sometimes pretty controversial digital assets out there, the XRP ledger and the whole Ripple ecosystem around it.
That's right. If you really want to cut through all the noise and understand what this project actually aims to do, especially for institutions, then yeah, this is the deep dive for you. We're focusing right on the core mission, how the tech works, who it's really built for, and maybe most importantly, where the big risks are hiding. We're trying to take this pretty dense corporate tech and just boil it down, make it practical.
Okay, let's start right at the beginning then. Why does this even exist? What's the real world headache, the frustration that it's trying to solve, something that tech hasn't really cracked for decades?
Well, the frustration, it really all stems from the let's call them ancient pipes of global finance, specifically cross-border payments. We're talking about the system built around SWIFT and traditional correspondent banking. If a bank needs to send money overseas, the whole process is just painfully slow. It often takes days.
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 Yeah.
And it's super expensive, too. Fees can easily hit like $20, $50, sometimes even more for a single wire transfer.
Wow. And that high cost isn't just the fee the bank slaps on, right? There's something more fundamental, like a structural issue.
Exactly. That's the key. The real problem is trapped liquidity. For banks to actually guarantee an international transfer, they have to pre-fund accounts in all sorts of foreign currencies, all over the world.
The Nostra Vostra accounts I've heard about.
Yeah, precisely those. Nostro and Vostro accounts. And this forces banks to lock up just massive amounts of capital, money that just sits there, idle, waiting for a transaction that might not even happen for days. So the expense isn't only the transaction fee, it's the huge opportunity cost on all that trapped capital. And guess who pays for that in the end?
The consumer, I imagine.
Always. Banks pass those costs right on down.
Okay, so the old system is slow, expensive, and ties up billions. What's the sort of simple solution the XRP ledger brings to the table, the big idea?
The core idea, what the project calls the Internet of Value, is basically to make moving money, even large amounts, as quick and easy as sending an email, just seamless. And the main way they do this is through something called on-demand liquidity, or ODL. The crucial part is that ODL uses the XRP asset itself to eliminate the need for those pre-funded Nostro accounts.
Right, ODL, on-demand liquidity. That makes sense conceptually. But you mentioned an analogy. How does XRP actually act like this bridge?
Okay, yeah, think of XRP as like a universal voucher, or maybe a bridge currency. Imagine a huge currency exchange counter at a massive international airport. Now, in the old system, that counter would need these enormous vaults stuffed with huge piles of every single currency pair you can think of. Dollars, yen, euros, pounds, just sitting there waiting for someone to maybe make a trade.
That sounds like a complete logistical nightmare and really expensive just to maintain.
It absolutely is. But with ODL, using XRP as the bridge, that counter doesn't need all those vaults anymore. It just needs a small, readily available stack of the universal voucher that's the XRP. So the bank sending the money starts the transfer in its local currency, say US dollars. That dollar amount is instantly converted into XRP.
Right.
Then that XRP zips across the XRP ledger. This takes just 3 to 5 seconds. And at the destination, maybe in Mexico, it's instantly converted back into the local currency, Mexican pesos. The banks only need to hold XRP for that brief moment, just bridging the gap. It solves that whole trapped liquidity problem like instantly.
Got it. So the bank's exposure to XRP is literally just seconds. And they avoid having to pre-fund accounts in dozens of countries. That's clever. But how does the XRP ledger manage that 3 to 5 second settlement speed? It's not like Bitcoin mining, right? Not proof of work.
Oh, absolutely not. No mining involved. The XRPL was designed from the ground up to be lean and incredibly fast. It doesn't use that energy-guzzling proof of work, and it also doesn't use proof of stake, which can tie up a lot of capital. Instead, uses a unique consensus mechanism. It's called the Ripple Protocol Consensus Algorithm, or RPCA. It's technically a variation of something called a Federated Byzantine Agreement model.
RPCA, FBA. Okay. Sounds pretty technical. What's the simple takeaway from that choice? What does it mean in practice?
Well, essentially, it means they traded some of the, let's say, open, permissionless nature of systems like Bitcoin for speed and the kind of security that institutions demand. It relies on a set of independent servers called validators. For a new transaction block or ledger to be confirmed, a supermajority, specifically 80% of these trusted validators, must agree. This sort of curated consensus is what allows it to hit that final settlement in just 3 to 5 seconds.
Okay, so it's a trade-off. Less decentralization maybe compared to Bitcoin, but you gain the speed and reliability that regulated financial institutions really need. They prefer that kind of trusted, maybe more controlled environment.
That's exactly the trade-off, and security is absolutely paramount in this design. The system is built so that if that crucial 80% agreement isn't reached for some reason, the network actually halts. It stops processing rather than risk confirming a bad or incorrect transaction.
So it prioritizes correctness over constant uptime.
Precisely. Correctness first. And this focus on reliability is a big reason why the ledger has, according to the sources, operated continuously without major errors for over 10 years now. It's confirmed something like over 63 million ledgers in that time.
Okay, that's impressive reliability. Let's switch gears to the practical benefits. When institutions start using this and saving all that money on trapped capital, how does that actually translate into real-world impact for, regular people like us?
Well, for the institutions themselves, the savings can be huge. Our sources suggest that by using ODL and eliminating that trapped liquidity, they could potentially cut their capital costs for cross-border payments by as much as 70%.
70%. That's massive.
It really is. And the theory is, right, that these massive savings should eventually trickle down to consumers. We should see much faster international transfers, maybe almost instant, and significantly lower fees.
And when you say lower fees, you mean negligible, right? The transaction cost on the ledger itself is tiny.
Oh, negligible is almost an understatement. The base transaction fee on the XRPL starts at 0.000001 XRP. Just think about that. You could literally make like 1 million XRP transactions for less than the price of a candy bar.
Okay, that puts it in perspective. And are we actually seeing this translate into real institutional momentum, like this year, based on the data we looked at?
Yeah, definitely. The institutional adoption seems to be picking up speed. The on-demand liquidity service reportedly handled something like $1.3 trillion in cross-border payments just in the second quarter of 2025. That's a huge number.
1.3 trillion in one quarter.
In one quarter. And we're also seeing big names like DBS Bank in Singapore and the asset manager Franklin Templeton starting to partner up and use the XRPL. And not just for payments, but also for tokenizing assets specifically. They mentioned money market funds. So the use case is definitely broadening.
That growing institutional comfort level, though, it has to be linked to that huge regulatory news that came out recently, right? The SEC case.
Oh, absolutely. That was pivotal. The resolution of the SEC legal battle. I mean, even though Ripple ended up paying a fine for some past institutional sales, the ruling itself set a landmark legal precedent in the U.S. Critically, the court ruled that the everyday retail sales of XRP on public exchanges are not securities. That gave XRP this really unique level of regulatory clarity in the U.S. market. Clarity that basically almost every other major digital asset is still fighting tooth and nail for.
And that kind of legal clarity for a big bank or a financial institution, that must be like gold dust.
It's probably the biggest competitive advantage you could ask for right now in this space. And it clearly drove institutional confidence. Sources mentioned something like $8.4 billion in institutional capital inflows reported almost immediately after that news broke. And now, well, analysts are predicting something like a 95% chance of a spot XRP ETF getting approved by the fourth quarter of 2025. There are apparently 7 applications pending from big players like Grayscale and Bitwise. So yeah, this project has definitely moved from the courtroom right into the boardroom.
This is a great point to quickly pause and remind our listeners of something.
That's right. If you're enjoying how we break down these complex projects into simple pieces and want more reviews just like this, make sure you subscribe to our channel, CryptoBox. We do all the complex research so you don't have to.
Welcome back. Okay, we've covered the incredible speed, the massive potential use case for institutions, and that really critical regulatory win in the US. But, we always have to look at the other side of the coin. Let's talk about the trade-offs, the criticisms, the major risks. And the first one is kind of the elephant in the room, isn't it? Centralization.
Right. This has always been the project's sort of historical weak spot. It's the criticism that just won't go away. And it really goes back to how the tokens were first created and distributed. The full 100 billion XRP tokens were created at the very beginning, pre-mined. And a huge chunk, 80 billion of them, were initially allocated to the founding company, Ripple.
Wow, 80 billion to the company. And what about today? How centralized are the holdings now?
Well, Ripple, the company, still holds a significant amount. About 42% of the total supply, if you include the large number of tokens still locked up in escrow accounts. But maybe even more telling, if you look just at the XRP that's actually circulating and available to trade, the ownership is incredibly concentrated. The top 100 wallet addresses control over 71% of all circulating XRP.
71%,
Yeah.
held by just the top 100 addresses.
So is the term decentralization even really meaningful for the XRP ledger right now, or is that still more of an aspiration, a future goal? That's the central paradox, isn't it? It raises some pretty serious questions about potential market influence and how genuinely decentralized the network really is today, especially when you combine that ownership concentration with the consensus model we talked about, the one relying on that curated list of trusted validators. It really suggests that, the control structure is still quite centralized around Ripple, the corporate entity, and just a handful of very large holders. And that's understandably a major point of criticism from the broader crypto community that values decentralization above almost everything else.
Okay. And that heavy concentration of ownership, it seems directly linked to the second big risk people talk about, the predictable supply pressure from those escrow releases.
Exactly. To manage that huge initial supply they held, Ripple set up this transparent escrow system. They release 1 billion XRP onto the market on the first day of every single month. Now, to be fair, they usually end up putting a large portion of that, sometimes most of it, back into escrow for later release. But still, that structure means the market has to potentially absorb up to 1 billion new XRP every month. This predictable supply dump, even if partially re-escrowed, creates this constant sort of background selling pressure. It just makes it inherently harder for organic demand alone, whether retail or institutional, to really push the price up significantly compared to assets with a truly fixed supply or maybe a more deflationary model.
Right, that makes sense. And thinking about XRP's role as that bridge asset, doesn't its own price volatility pose a risk to the institutions actually using ODL?
It does, yeah. Market volatility is always going to be a risk factor for any kind of intermediary or bridge asset. That's just the nature of crypto markets right now. However, the system's design is meant to minimize that exposure risk as much as possible. Remember, the actual transaction, the hop from one currency to XRP and back to another, completes in just 3 to 5 seconds. So the institution is only exposed to XRP's price fluctuations for that incredibly short window. That speed is really the critical mitigator against the volatility risk.
Okay, speed is the defense there. And finally, what about competition? Is the old guard, like Swift, catching up, or are newer, faster blockchains a threat?
Competition is definitely fierce, no doubt about it. Swift isn't standing still. They've got their Swift GPI initiative, which is already significantly faster and more transparent than the old Swift system. It's a big improvement. And then, yes, you absolutely have other fast blockchains vying for similar territory. You've got Stellar, XLM, which is often seen as a direct competitor, though it maybe focuses more on different use cases, sometimes non-bank remittance corridors. And then you have general-purpose fast chains like Solana, competing purely on transaction speed and low cost, which could potentially handle mass payments. So to stay ahead, the XRPL really has to keep innovating. Things like their planned smart contract capability called hooks, which would let developers build custom logic directly into transactions. And new sidechains compatible with the Ethereum virtual machine, the EVM, to connect better with the wider world of decentralized finance, or DeFi. They can't afford to stand still.
Okay, that definitely gives us the full picture, the huge potential, the advantages, but also those unavoidable trade-offs and risks. Let's try and wrap up our deep dive then with a quick summary. If you had to boil it all down, what's the 1 or 2 sentence summary you'd give our listener about the XRP ledger?
Okay, I'd say XRP is a technologically mature, very specialized digital asset and ledger. It provides near-instant, super low-cost liquidity primarily for institutions, and it's laser-focused on fixing that old, clunky problem of cross-border finance. And crucially, it recently gained that unique regulatory clarity in the U.S. market, which really positions it strongly for potentially much wider institutional adoption moving forward.
That's a really helpful distillation. Okay, now for the final provocative thought, what's the big question, the thing our listeners should maybe walk away mulling over after hearing all this?
Well, despite its decade-long track record, its proven technology, and that hard-won legal victory against the SEC, the real test, I think, for XRP's long-term success isn't just about winning more court cases or signing up new banks. It's this fundamental question: can the decentralized community that actually operates the ledger ever truly outweigh the significant influence and the highly concentrated token holdings of Ripple, the corporation that originally built it? That underlying tension between the corporate control and the decentralized ideal, that's probably what will ultimately define XRP's future path.